With chaos at the New York Stock Exchange.
Get back in there at once and sell! Sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's going crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come, trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, August 16th, 2024. What a solid week for the markets. Wow, nice big turnaround. 2 weeks ago, the world was falling apart. Chicken Littles were running all around the place, screaming for the Fed to step in and do emergency rate cuts, and it was the end of the world as we knew it. Who sang that song? REM? Anyway, and here we are 2 weeks later, and we're approaching all-time highs almost. We're not quite there. We got a little bit of work to get to the all-time highs, but the bottom line is we're a lot further than where we were. And everybody was saying, oh, wait, don't buy yet. We jumped in. We bought it pretty aggressively. I think it's worked out pretty nicely. One of the things we've been talking about when it comes to the market is downtrends and uptrends. And one of the things that I wanted to see was the market get to a higher high from its last high that we had. You know, we get these ups, we get downs, ups and downs, and you want to get a higher high than the previous one. We are kind of like right there. I haven't quite fully crossed it yet. I'm looking at the highs on August 1st, and we haven't quite crossed that yet. We are super, super close. Maybe we'll get that Monday. But, we want to see that, or we're going to remain in a bit of a downtrend potentially here for a while longer, maybe between now and the election. But we'll see. This week was a really productive week for the market. Let's just go and jump into the numbers. The Dow Jones up 2.9% this week. The S&P 500 up 3.9% on the week. The NASDAQ composite, a lot of your tech stocks, growth stocks in there, up 5.2% this week. And the Russell Small Cap also joining the party, up 2.9% on the week. The volatility index, which was at 65 2 weeks ago, dropped 27% this week, all the way down to a 14.8. We're getting right back down to that level of complacency that we've been in most of the year, outside of a couple of spikes in October and that big one here the last couple of weeks ago. Volatility index has worked its way back down, again, showing that markets aren't too nervous about what lies ahead in the next 30 to 45 days or so. Looking at some other things, long-term bonds as measured by the TLT. That's a basket of long-term treasuries, up 1.2% this week. So that made some gains. Gold was up 3.3% this week. Silver up 5.7%. And we take a look at all of the sectors. Everything was good. It was just an everything kind of rally, with the growthier stuff, if that's a word. Is growthier a word? The growthier stuff doing a little bit better. Semiconductors up 9.7%, tech up 7.5%, industrials up 2.1%, retail sales up 5%. So what pushed markets higher this week? Well, we had some good news on the economic front, some pretty solid news. We had some big inflation numbers coming out this week. The PPI, that's a producer price index. That's like wholesale numbers, right? So when one business is selling to another, or the price is going higher or lower, that came in better than expected. Again, we want to see things taming a little bit on the inflation front. So any cooler numbers on PPI, that's a good thing. And then we followed that up with a cooler CPI. That's a consumer price index that measures inflation for the individual, for the retail consumer. That was also better than expected. And then we followed that up with a much, much stronger retail sales number. And that's big because, listen, the consumer, look, a lot of companies are reporting earnings and they're suggesting that consumer is weakening a bit. And I find it kind of interesting as I've been reading these earnings reports and hearing, the consumer here, the consumer this, consumer that. To me, it's not been very consistent. It seems like some companies blame a weakening consumer and their numbers aren't quite there. Others have said the consumer is fine and doing just fine and doing great, maybe even strengthening. We're not getting the same narrative from all companies. Seems like it's a bit of a mixed bag here in that. And then Walmart reported this week, and we don't have it in any of our models at the moment, but they reported a monster quarter. That stock just went straight up. I mean, what a huge move it had on a really strong quarter. So I've been scratching my head a little bit as to why the narrative amongst different companies is so vastly different from one to another. I think some of it may be the consumer still spending money, but I think they're looking for more value for their dollar. And as you kind of read the tea leaves and you hear which companies are still struggling and blame it on the consumer and which companies are doing great, i.e. Walmart, and crediting the consumer, it seems to me that consumers are still spending. They're just steering their spending in different directions and maybe looking for more value for their dollar. And maybe that's why Walmart's doing so well. I think a lot of higher end, wealthier consumers are starting to change their spending habits a little bit. And I think that's where Walmart's picking up its additional sales. I think if people are trading down. And then the lower end consumer, I think, is under some pressure right now. We're seeing the credit card defaults, auto loan defaults, things like that a little bit higher. But, what's interesting is it used to be years ago when things started slowing down for the consumer, Dollar General did great. But it seems like Walmart is just supplanted everybody. It's like if you want the best deals, you just kind of go there. It seems like that's who's really cleaning up at the moment. And any sort of retailer is really discounting well. So that's what we've been seeing. So earnings season is really winding down right now. We have seen earnings growth on the S&P 500 at about 10.9%, almost 11%. And that compares to 8.9% at the end of last quarter. So we're seeing earnings growing more than they did last quarter. That's a good thing. Revenue, however, not growing so much. And revenue, top line revenue, I think that's important. That shows the amount of sales actually being conducted by businesses. And that was a little bit on the lighter side, a little bit light on the average as well. So that's something I've been watching. We talked about it coming into this quarter, that I think that companies can continue beating earnings if they continue to work the numbers really hard. But what we really want to see is revenue growth. We want to see more money coming in, more top line growth, because if that continues to contract, you can only do so much magic with the bottom line, right? You got to have that top line. The top line's not there. Eventually, you're going to run out of steam. So we do want to see some acceleration on the top line. We'll see what the next quarter brings. But I think overall, if you compare both the bottom, top, and all of the companies that have reported, I'd give earnings season a B. I wouldn't quite say a B plus, but I'd give it a B. So I think it's been okay. I think overall it's been okay. And we've seen pretty wild outcomes from companies that have executed versus companies that have not. But it's coming down to a close. We're kind of winding down. We're going to be going to a period where it's not going to be a whole lot to talk about. The Fed's going to have Jackson Hole meeting out there in Wyoming, where they all get together and talk about the economy. They'll probably set the stage for rate cuts in September. I think the market's looking for that. I think the inflation data that came in this week helps give the Fed cover to go ahead and make that rate cut. So we're going to be in a period of time, probably from now well into September, where things are just going to be driven a little bit by headlines, those types of things, what the Fed might have to say, things along those lines. So I think we're in a pretty good spot. We did a lot of buying here a couple weeks ago. Real happy that we did. We jumped in, we bought hand over fist there when the market was getting hammered a week ago this past Monday, and it's played out very nicely. But I don't think we're out of the woods yet. We haven't got that higher high yet. Got real close today, but we're not quite there yet. We want to see the market break out of this downtrend, this little miniature downtrend that it's in. I'm not sure it will. It might, but I'm not sure it will. I do think that the intermediate technicals on the market do look a little on the weak side, but that's to be expected. I think, as I mentioned maybe last week, that we'll probably have a retest of that low from 2 weeks ago at some point. Probably lines up well with end of September going into October ahead of the election. So I like where things stand for us. We're going to stand pat right now. I'm not going to get too cute. Don't overtrade. Just kind of want to keep what we've got. keep the positioning that we have, see if this retest comes about, see what the data looks like if it happens, and then go from there. Otherwise, we're starting to look at 2025 at this point. And I do think that as we move into 2025, we're going to be looking to position ourselves a little bit more defensively, kind of brace ourselves for maybe some more economic weakening and a potential recession. Because I don't think we're out of the woods on that yet either, even though a lot of our industries kind of waving the victory flag. I think it's premature to do that. So I'm going to wrap up. Not so long this week, right? But between now and next few meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it is build that second home somewhere, an Airbnb it, or retire a little early, or take that big trip. I got a couple clients taking some nice cruises. You know what your goals are. Don't just think about them. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.